All right, let's talk about a scenario that, well, it's something no business ever wants to face. A partnership built on years of hard work and trust is suddenly thrown into chaos by a personal tragedy. When a partner passes away, it's not just an emotional blow, it's a potential financial earthquake. So, how does a business actually navigate this incredibly delicate process? Let's get into the accounting that keeps a company from falling apart.
And this is the big question, right? It's the one that can literally make or break a surviving business. A partner's death triggers an immediate financial duty to their family. But, where does that cash even come from? How do you figure out what a fair amount is? And maybe most importantly, how do you manage to pay it out while making sure the company itself survives?
Okay, so the first thing you've got to understand is that a partner's death isn't just a personal event, it's a formal business event. In the world of accounting, it triggers something called a reconstitution. You can think of it like this. The original partnership technically dissolves, and a brand new one has to be formed by the partners who remain. It's essentially a complete reset.
So, what's the goal here? What are we actually trying to achieve? Well, it's a really delicate balancing act. On one hand, you have a legal and, frankly, a moral duty to give the deceased partner's family fair compensation for their share of the business, the one they helped build. It's like cashing out their stake. But on the other hand, you absolutely have to protect the business from a sudden, massive financial drain.
Now, I know this probably sounds super complicated, maybe even a little overwhelming, but here's the good news. Accountants have a clear roadmap for this. It's a structured, 7-step process that's designed to make sure everything is calculated correctly and fairly, protecting both the family and the business.
So here it is. This is basically the official checklist. It covers everything from figuring out new profit ratios to handing out old reserves. But look, don't worry about memorizing this entire list. The truth is, the real make-or-break moments, they happen in just a few key areas. Figuring out the business's true value, accounting for its reputation, and having a solid plan to actually fund the payout. Let's focus on those.
Right, so the first huge step is figuring out what the business is actually worth. And I don't mean what it was worth last year or 5 years ago. I mean what it's worth right now, today. This means you got to hit pause and take a completely fresh look at every single asset and every single liability.
And this brings us to a really big point, the difference between book value and market value. So your accounting books, they might say the company building is worth what you paid for it 20 years ago. But we all know the real-world value, the market value, could be 5 times that today, right? This revaluation is all about getting to the business's true current worth, because that's the number everything else is built on.
But a business is so much more than just its buildings and equipment. Some of the most valuable parts are the things you can't touch: the reputation, the loyal customers, the brand you all built together. And that stuff, it has a real, tangible value that you can actually calculate.
In the accounting world, there's a name for this. It's called goodwill. It represents the extra earning power a business has simply because of its good name. And since the deceased partner helped create that goodwill, their estate absolutely has to be compensated for their share of it. This is often one of the biggest and most important parts of the whole calculation. And just to give you an idea of how big a deal this can be, in one case study from the Institute of Cost Accountants of India, the goodwill alone was valued at almost 2 lakh rupees. Imagine forgetting to account for that. That would be a massive injustice to the partner's family.
Okay, so we've revalued everything, we've accounted for goodwill, and now we have this big final number that needs to be paid out. Which brings us to the most practical, and let's be honest, kind of terrifying question of all. Where is the cash going to come from?
Yeah, this is that cash flow crisis we talked about at the start. A sudden demand for hundreds of thousands or even millions can absolutely cripple an otherwise healthy company. You can't just sell off the factory equipment to pay the bill. So what's the solution? How do smart partnerships get ahead of this?
Well, they use this incredible financial tool called a joint life policy, or JLP for short. Just think of it as the ultimate financial safety net. The business pays the premiums on one single insurance policy that covers all the partners. The moment one partner passes away, the policy pays out the full amount directly to the firm, giving it the exact cash it needs to settle the account without disrupting day-to-day operations.
Now, this is a really important detail to get right. You see, a JLP has 2 different values, and it's easy to get them mixed up. The surrender value is what you'd get if you just canceled the policy early, but in the event of a death, that number is totally irrelevant. The firm gets the full maturity value, the entire insured amount. That's the crucial number. That's the number that solves the entire cash flow problem, right there.
All right, we're on the home stretch now. This is the final step. All the hard calculations are done, the money's there, hopefully from that JLP, and it's time to formally make the payment and settle the deceased partner's account once and for all.
And you don't just hand a check over to any family member. The payment is made to a specific person, the executor of the partner's estate. This is the legally appointed person in charge of handling all of the deceased's affairs, which ensures the whole process is done by the book, formally and properly documented.
When it comes to the actual payout, it usually happens in one of two ways. And this is where having a solid partnership agreement really pays off. If the firm has the cash, ideally from that JLP we talked about, it can just make a single lump sum payment and be done with it. If not, the amount gets turned into a formal loan from the estate to the firm, which is then paid back over time in installments with interest.
And hey, don't just take my word for it. The Institute of Cost Accountants of India says it right there. The amount payable can be made either immediately or as deferred settlement. So the choice is there. The key is that the method is agreed upon and formally carried out.
So after going through this whole thing, from revaluing assets all the way to that final payment, the real question isn't just about accounting, is it? It's really about foresight. Is your partnership actually prepared for something like this? Because having a clear, detailed partnership agreement that spells out every single one of these steps, that isn't just good business practice. It's the key to fairness, to continuity, and to the very survival of the business you've worked so hard to build.